afternoon. Welcome to third day of the ICREMV 2020, the first virtual conference of its history. The third day of the conference is focusing on the experience sharing of experts. During times of economic distress, that conventional wisdom can be thrown into question. The 2008 global financial crisis, which is originated in the property market, was a major knockout on confidence. 2020 is another turning point where COVID-19 creates a blackout. However, experts broadly agreed that this downturn can be managed with innovative solutions. It might be a real estate investment trust, smart technology, or adapted valuation approach. This creates a smart real estate, a sustainable and marketable real estate with the aspiration of society, reinforce wealth and transform economy. The broader theme of the conference, smart real estate, unmet socio-economic needs. In today's session, the industry experts will be discussing post-COVID-19 implications on local and global real estate market. You, as participants, can engage through expert exposition via questions and comments. Now, I would like to invite the master of the ceremony of today's session, Ms. Ashini Vikramasinghe, lecturer of the Department of Estate Management and Valuation, to take over the session. Over to you, Ashini.
All right, very good afternoon, everyone. We would like to welcome you all to the Industry Dialogue session, the third day of the fourth International Conference on Real Estate Management and Valuation 2020. We are delighted to have the participation of all of you in this session. We had a glorious inauguration session and the academic session at the first and the second day of the conference. And I assure you that this would be another captivating session. So, ladies and gentlemen, in this session, over the next 3 hours, we will have the privilege of having 4 dignitaries sharing their knowledge and insights on red hot and trending key priorities of real estate valuation, management, and planning. Before we get started, I would like to take you through the purpose of this session. The industry dialogue aims to facilitate industry experts to discuss post-COVID-19 implications on both local and global real estate markets. And each speech is followed by a question and answer session at the end. All right, now I would like to kickstart today's session by introducing the respected dignitaries who are joining with us today as our key presenters. The first dignitary who will be doing the first presentation today is an expert from the industry, the Director, Corporate Affairs, Securities and Exchange Commission of Sri Lanka, Dr. Harshana Surya Perumal. The second dignitary who will be doing the second presentation is a Chartered Valuation Surveyor and the Secretary of the RICS Sri Lanka Leadership Forum, Mr. T. Pratap Singha. Our third dignitary is a Professor in Real Estate Management and Valuation from the Department of Estate Management and Valuation, University of Sri Jayewardenepura, Sri Lanka, Professor Mrs. K.G.P.K. Veerakorn. The final presentation will be done by Chartered Valuation Surveyor, Valuation Manager at Valuestrat Qatar, Valuestrat Dubai, United Arab Emirates, Mr. Anthony Fernando. Once again, I welcome all of you and thank you for joining with us to grace this event today. Before commencing the presentation, allow me to let you know today's topics. First presentation will focus on the real estate investment landscape of Sri Lanka and SL REITs. And second presentation will focus on assessment of fair value of bearer biological assets for financial reporting purpose. Third one will focus on information for smart real estate. And the final one will focus on dealing with uncertainty from COVID-19 pandemic in assessing market value of office building complex. So it's clear that we have an exciting itinerary we have ahead, and we truly hope that this session would be informative and at the same time full of learning for all of us. So if you need to raise a question of any of the presentations during the session, please use the chat box. We are prepared to direct all of your questions to the respective resource persons and get their expert view on them. So before moving to the speech, let's quickly move to a small video clip of the University of Sri Jayewardenepura, Sri Lanka.
A place like no other, they say, is the University of Sri Jayewardenepura, located just 15 kilometers away from Colombo, nesting over 10,000 students coming from varying parts of the country to obtain their higher education. Marking the renaissance of Pirivnu education, Jaipur is recognized as one of the most mature and picturesque state universities of country, offering courses and programs leading to officially recognized education degrees, such as bachelor degrees, master degrees and doctorate degrees in several areas of study.
Pirivenu has become University of Vidyodaya, like Cambridge or even Oxford.
Jaipur, best known for its excellence in the Faculty of Management and Commerce, has also proved exemplary in the faculties of Applied Sciences, Humanities and Social Sciences, Medical Sciences as well as the Faculty of Graduate Studies. It has also laid foundation to open up the Faculty of Technology and the Faculty of Engineering, along with the concept of creating a university village, wherein state-of-the-art facilities and a more promising environment. University is also known to have one of the best library facilities of the country, which has in it resources both updated and also those which cannot be located elsewhere. The university, same as every other state universities of the country, offers its internal students hostel facilities as well as Mahapala and other student scholarship facilities. It is an active career guidance unit, which equips the students with career opportunities and advice around the clock.
Water Research Center, Cancer Research Center, Center for Nanotechnology, Biotechnology, Biomedicine, with the collaboration of Japan and India, and also two centers, one for Faculty of Arts, Humanities and Social Sciences, and the other one for Business. So,
in terms of extracurricular, the university has invested a lot of time and effort in uplifting the sporting abilities of its students, thus paving the way towards having fully fledged sporting arenas and areas. Results of this commitment, by both the administration, and especially the sportsmen and women, have been seen throughout the past years, in terms of emerging champions in Sri Lanka University Games. Jaipur, most of all, will teach its disciplines humanity, it'll teach them the beauty of diversity, it'll teach them tolerance, and most of all it'll teach them people. Therefore this university, with its luscious greenery, long walks, air and beautiful people, is indeed a hub of universal education.
Right, thank you very much, ladies and gentlemen. Now we can move to the first discussion. Before that, we have arranged an introductory video for our first resource person. Let's move to that now. the global context, real estate investment trusts have become an integral part of the investment landscape. In Sri Lanka, too, the potential benefits to the domestic economy from the introduction of REITs are significant. So, without further ado, to talk about this trending key topic, the real estate investment landscape of Sri Lanka and Sri Lankan REITs, I would like to invite the Director Corporate Affairs, Securities and Exchange Commission of Sri Lanka, Dr. Harshana Surya Peruma. Dr. Surya Peruma holds a Master of Business Administration and also a PhD in Business Networking and Business Performance. He is also a Fellow of Association of Chartered Certified Accountants, Fellow of Chartered Institute of Management Accountants, member of Certified Public Accountants, and also member of Chartered Institute of Marketing Sri Lanka. So, with all due respect, I would like to hand over the session to Dr. Harshana Surya Peruma to proceed with the presentation.
Very good afternoon to you. First of all, thank you very much for the introduction, and I would like to congratulate on behalf of the Securities and Exchange Commission of Sri Lanka for the initiative to take the message across relating to the importance of the role on real estate valuation, the key stakeholders, including regulators such as the Securities and Exchange Commission of Sri Lanka. Trust my presentation is visible to participants. So to start with, the regulatory landscape relating to real estate investments all this time in Sri Lanka, in this island nation, was not regulated vis-a-vis the securities investment regulations. Any investor could have invested in real estate without such investment being regulated by a state-appointed regulatory body. That gap that exists in the nation is now bridged with the introduction of the real estate investment trusts in Sri Lanka. The Gazette was introduced in July this year in 2020, wherein the real estate investments is now brought into the capital market investment products basket, where general public particularly can invest with confidence in products created through this framework, predominantly based on real estate assets. Let's go through some of the details relating to the specificities on the real estate investment trust structure in Sri Lanka. The SEC, the capital market regulator, one of the objectives is to ensure the participants and stakeholders are aware of these new products that we are creating, new regulatory frameworks that we have created, and who will be within the regulatory framework. So the SEC, or Securities Exchange Commission of Sri Lanka, will continue to endeavor to take the message across, and that's where we are happy to be partner with initiatives of this nature, where the regulation and related aspects are taken across to the public and beyond borders as well. So continuing, in 2016, national budget in Sri Lanka highlighted, based on the representations by the SEC, it is important and it is imperative that as a nation, we bring about real estate investment trusts to Sri Lankan investment community and even foreign investors who are investing via the Colombo Stock Exchange. The framework was approved and it was to be designed and implemented. Over the course of subsequent years, the SEC and the Colombo Stock Exchange provided the framework with the ability to convert existing income-generating properties to real estate investment trusts. So this is a key feature and a differentiator compared to certain other real estate investment trust framework available elsewhere in the world. We will go through in greater details in a short while. And then the REIT structure provides significant cash flow advantages to property owners as well as to investors in these REITs mechanism through collective investment schemes. In Sri Lanka, the REITs are considered as tax pass-through structures to provide advantages to investors, particularly when it comes to distributable income. Such income is not taxed in the hands of the REIT. Instead, it is considered the REIT is the managing agent and final beneficiary is to be taxed depending on the applicable tax rates. So this terminology are common across many countries. They are using similar terminology. So Sri Lanka also has adopted tax pass-through structure for real estate investment trusts. Then this slide provides a brief of the architecture in Sri Lanka, how we have created the real estate investment trusts. It is a booming sector in the economy. Because of that, it has been categorized and adequate measures and safeguards have been brought in to safeguard the interests of investors, to ensure credibility of the framework and the sustainability of investment instrument over a longer period of time. There are three significant approaches or sectors. One is the regulatory structure. The middle column is on the REIT structure, and the right-hand column is on the asset structure. The regulatory structure for REITs has two components. One is the SEC framework or the gazette that we have issued to enable creating REITs in Sri Lanka within a legal framework. All this time, if there was a REIT that has been created that is without a formal legal framework, with the SEC introducing the REITs gazette, it has now obtained the legal validity to create valid real estate investment trusts in Sri Lanka. And the second component in the regulatory structure is relating to the listing rules applicable for REITs. It is another differentiating factor for our international counterparts who are joining us today. In many countries, REITs could either be listed or it could not be listed. Option is either with the managing company or with the sponsor or with the trustee. In Sri Lanka, a differentiator is all REITs created within the capital market framework has to be listed. So it's not an option to not to have a unlisted REIT. We are going to go through some of these details in a short while as well. Then let's look at the REIT structure, which is in the middle column. The most important party who will combine this entire proposal is the managing company. It is the picture of, or the image of the person in the suit, the managing company. He will have the discussions, or the managing company will have discussions with the sponsor or the existing property owner, and line up unit holders to acquire units once the REIT is created. And the managing company will engage with the trustee who's supposed to overlook the operations of the real estate investment trust based on the provisions of the trust deed. So it's a commercial bank that is allowed in Sri Lanka. So we will go into more details into roles and responsibilities of these parties. Another significant role is played by the property manager, which is the image at the bottom of the REIT structure. Because these are habitable properties and safety concerns and many other measures, it is imperative that the managing company has appointed a competent property manager to ensure the real estate asset is maintained at the most desirable level to generate the best premium and returns as rental income and capital gains over the period of time. Then the final sector, which is the asset structure. In other countries, the participants who are familiar with the real estate investment structures, you would have noted, it is greenfield REITs are allowed in other countries. But in Sri Lanka, as the phase one or as the starting point, we allow only completed assets that are already generating income to be brought into real estate investment trusts. We will go through the details as to why and how in a short while. So this is a brief snapshot of the entire REITs structure in Sri Lanka, which comprises, to summarize, the regulatory structure, REIT structure, and the asset structure. Then this gives further elaboration on the framework. The SEC Act, Securities and Exchange Commission Act, empowers and enables creation of new products similar to that of the unit trusts that we have. These are various types of collective investment schemes. So under the existing unit trust code, under collective investment schemes, a gazette to be issued, which has now been issued, to create real estate investment trusts in Sri Lanka, which has, the gazette has three components. One is the development of the real estate framework to in a manner to meet the requirements of Sri Lanka as a nation. Then the second aspect is drafting the gazette and issuing the gazette. And this particular section has two requirements. The REITs that are coming on board, there are two types of requirements, which is requirements at the time of obtaining the license or granting the license, then continuous monitoring requirements vis-a-vis the requirements of the gazette. That is relating to the REITs obligations. Then a third component is the mention in the right-hand side. Once again, it has two components. First one is requirements at the time of obtaining the listing for the REIT. And the second component is continuous listing requirements for the REITs. We are going to go into greater detail in a short while. This is a snapshot or an image of the front page of the gazette that we have issued to enable creating REITs within a legal framework. This is now in force. It forms part and parcel of the law in the country. Some of the benefits particularly to Sri Lankan investors who are new to real estate investment trusts and the propositions applicable to the managing company. Let's go through the benefits to investing public. It will allow investors to obtain increased returns from the growing property sector. The theme of the session over the period of last few days that the university is discussing is the prosperity that has been brought about by the real estate sector and perhaps the challenges continuously, the existence and the credibility of the sector, relating to the credibility of the sector. Whereas the general public of the country was not able to take part in the prosperity because of the exorbitant prices of real estate sector. Invest in real estate sector prior to bringing in real estate investment trust, it requires a lot of funding, which is a difficult criteria to satisfy by most of the average investors in the country. But by introduction of REITs, that has taken away that barrier, which will allow ordinary citizens and individuals to invest in real estate segment with relatively smaller amounts of money. And it is as low as probably closer to $5 in an international terminology. From Sri Lankan values, it is 1,000 rupees as a starting point, which is a significantly lower amount compared to the amount of financial resources that is required to acquire property. I'm sure everyone would agree to that one. So that's a significant benefit to investing public. It will allow them to invest in this growing sector and benefit from the returns. And the second significant benefit is capital appreciation reflected in the unit price. Now, as I indicated, compared to other countries, in Sri Lanka, the REITs are required to be listed REITs. Because REITs are listed in the Colombo Stock Exchange, the daily trading reflects the prices of the units, which essentially factor the compounding effect of capital appreciation, the income generation possibility of the particular property, etc. So this is another advantage. By investing, the individual investors are able to attract the capital appreciation segment into the price as well. Then the third element, ability to minimize volatility through 90% rental income distribution. Once again, this is another requirement from Sri Lankan perspective. There can be some differences to certain other jurisdictions. In Sri Lanka, it is mandatory. The real estate investment trust must distribute 90% of its income. So this is another advantage whereby it provides cash flow advantage and certainty to investors with the predictability of cash flows. So now REITs or real estate investment trust can compete with other financial products offered by the banking sector, such as the deposit schemes with regular cash payments, because REITs is also allowed to now, depending on the structure, the dividends to be paid either on a monthly basis or on a quarterly basis, biannual basis, and annual basis, etc. Then liquidity attached to the market through listing, as I indicated, these are listed REITs. Therefore, the trading happens and it brings about the liquidity. It further brings about transparency and develop governance demanded by a listed entity. Then mandatory valuation to provide transparency. This is a very important provision in the Sri Lankan legislation relating to REITs. It requires mandatory valuations. We will go through in little more details. And to the managing company, it allows to diversify the income portfolio by adding REITs into their existing structures. Then they can convert their existing unit trust clients straight away to real estate investment trust, which are similar form of collective investment schemes. It will allow them to increase industry visibility by becoming the first REITs manager in Sri Lanka, because REITs was introduced very recently, just few months ago. And it can provide them to capitalize on the shared overhead structures and combine marketing efforts, etc. So it will increase the attractiveness of their offering to investors, and obviously increase opportunities for additional fee income. There are various types of fee income. It could be the admission fees, it could be performance-related fees, annual fees. We are going to go into some of those details as well. Then the details relating to a managing company, it needs to be a company that is incorporated in Sri Lanka with certain restrictions. At least 50% or more of the capital has to be from local equity, and it should have a minimum funding requirement of 50 million at all times. Kindly note that is a continuous requirement. And the managing company should have entered into an agreement either for a purchase of a property or for lease of the property that is to be brought into the REIT, and it shall enter into a trust agreement with the trustee, and that trustee has to be an approved party by the Securities and Exchange Commission of Sri Lanka. Then the trustees relating to the details relating to trustee has to be appointed with the prior approval of the SEC, and it has to be a bank licensed by the Central Bank of Sri Lanka. The trustee is expected to play the fiduciary duty to hold the assets of the REIT in trust for the benefit of unit holders, and it shall ensure validity of title deeds. It has obtained the relevant approvals relating to the property, validity of contracts entered into, the properties are registered in the name of the trustees, valuation related details, legal audit as appropriate, and to ensure investment and borrowing limits are maintained for the REIT. Then permitted investment for REIT is, it shall allow only up to a maximum of 80% to be invested in real estate assets. And there are 3 criteria to be met, which is important. And there are some differences to the international context here. Criteria number 1 is such property to be fully completed, the property to be either fully or partially occupied, and the third criteria is 20% of the funds resources to be invested in government securities and or cash or near cash assets. The maximum amount to be invested in the real estate could further be increased based on prior approval of the SEC. This is particularly when the real estate asset is relatively new, which requires lesser maintenance, etc. Then the real estate property, it has to be purchased from the sponsor with the intention of leasing. It could be either residential or commercial property. The property could have also been leased from the sponsor with the intention of leasing, and it has to be a fully completed, and not only real estate typically identified real estate properties, any other property also could be considered as eligible, provided prior approval of the SEC is obtained. For example, income generating infrastructure assets also to be considered. Then it is important to note the role of the valuer to provide valuations to the real estate over the life of the REIT. The valuer has to be appointed. The valuer, it has to be a fellow member of Institute of Valuers of Sri Lanka or Royal Institute of Chartered Surveyors. The frequency of valuation should be every 6 months, meaning twice a year a valuation is required. And the valuation reports to be shared with the trustee, the managing company, the market, and the regulator, SEC as well. The various types of fees relating to the managing company could be either front-end fees, annual fees, benchmark performance fees, and various types of other performance fees. And the pricing of the units could be decided purely by the market, except at the time of listing, it has to be decided with the expert input. The suspension of units or dealing of units is dependent on the provisions of the Colombo Stock Exchange listing rules. If the company or if the listed REIT contravenes the provisions, the Colombo Stock Exchange may suspend the dealing of units. The creation and cancellation of new units and existing units are allowed. Right issue of units are also allowed to raise additional capital to acquire additional real estate properties. The types of properties, for some examples, it could be residential properties, commercial properties, warehouses, hospitals, hotels, infrastructure projects such as power generation projects, etc. Then it has to be listed within 3 months of obtaining the license. It could be listed through an IPO or even through an offer for through an introduction. It should have a minimum of 100 unit holders at the time of listing. And in order to be eligible to the tax advantages provided, it should maintain 50 members at all times. It is an important provision to note that the sponsor's stake is locked in at all times unless he is willing to introduce another strategic investor to play his role. This is to safeguard the interests of investors and avoid properties being dumped into the market via REITs. It should have a public float of 20% at the time of listing, and it needs to meet with the CST listing rules. These are some important criteria relating to the various listing requirements. Certain listing application has to be lodged within 1 month, and it has to be confirmed within 3 months. Additional disclosure requirements such as NAV disclosures, sponsors and strategic investor related disclosures, financial information and valuation reports, etc. And further issues which we briefly discussed could be right issues. It could even be private placements to raise additional funding for further capitalization. Then continuous listing requirements require a lot of reporting to keep the market informed of the financial health of the entity. It could be through interim financials, annual reports, NAV reports, and valuation reports. And the public float requirement is if the value of the real estate fund is less than $1 billion, then it should have 10% public float. But if the value is more than 1 billion, 7.5% as public float. And it needs to have independent directors requirements and various subcommittees such as audit committees and investment committees. And if the REIT is non-compliant with the requirements of the Colombo Stock Exchange, the enforcement rules will be applicable, including certain transactions and prohibitions between directors and key management personnel. It allows related party transactions. However, there are added burden if the REIT is to entertain related party transactions. These are some of the details relating to Sri Lankan context on transaction fees, etc., which is significantly lower compared to that of equity and debt listing. I would like to pay your attention to comparable analysis from other jurisdictions. This is a REIT listed in India. You can see the trading the REITs, the real estate backed REITs is showing resilience and prices are being picked up immediately. This is another REIT from India, which is traded in the national exchange. Once again, you can see the COVID impact and the prices are being recovered subsequently. This is a Malaysian example. This is to demonstrate REITs are widely accepted products among the investment community. This is another example from Singapore as well, with significant impact of COVID by showing the resilience and prices are improving immediately thereafter. The pricing mechanism is an interesting element, how NAV, the market price, and price as per valuation is behaving in the market. So these are 3 comparative details and information from other jurisdictions. So I suppose that brings to the end of my brief presentation. And Dr. Pratap, I'll be happy to take any questions for further clarification purposes. Thank you very much.
Yes, Dr. Surya Perumal, we have allocated a short session for question and answers. And shall we move to the question raised through one of the participants through the chat box? I hope you can see that. I will read. Financial crimes has been a hot topic these days. So, how the proposed REIT Act manage and protect the stakeholders from such events? Dr. Surya Perumal.
Quick response to that one is yes, there are issues, but as a nation, we have to start somewhere. This is the same example in many other countries. Rather, quite a number of safeguards have been brought in. Now, for example, if it is come to money laundering related financial crimes, there are provisions that are applicable for investors who are coming to play a role in the capital market. If it is an international investor, there are certain KYC requirements. If it is a local investor, again, there are KYC requirements. So these are built-in provisions to the existing legislation and rules and practices to minimize occurrence of such scenarios. In addition to that one, the SEC and the Colombo Stock Exchange will actively monitor whether any such financial crimes or rather capital market is being used as a ground to commit financial crimes, and perpetrators will be dealt in an appropriate manner. So as a regulator, we are vigilant and many measures are brought in. I'm sure the time is not enough for me to go into the details, but there are a lot of provisions already built into the REITs framework, into the existing CSE listing rules framework, and to the capital market regulation and legislation to deal with this type of issues. Thank you.
Right, and also I have another question. Actually, we know that this real estate investment trust frameworks, it differs from country to country. That means in Malaysia, Singapore, which are quite far eastern countries, and also European countries. So, what is the school of thought or the base that we should adopt when implementing this real estate investment trust in Sri Lanka?
Fundamental is we agree with all other nations who have created prior to us that real estate investment has to be accessible by the general public. That accessibility is created by broad basing the ownership through the units scheme or the real estate investment trust scheme. So that is the fundamental requirement, which we are also in agreement with the school of thoughts available elsewhere. There are certain differentiation factors because this is the time we are introducing for the first time, and to bring additional safeguards that's why we have limited it to completed properties that are income generating, etc. And that is why we are not allowing greenfield properties or ground up basically from acquiring a land and putting up a new building type of scenarios out of the equation. So there are a lot of similarities to the other products available in Europe, in Western countries, in rest of the Asian countries, but there are quite a few unique features of the Sri Lankan product as well, that is to accommodate the investment requirements of the country as well as investors. Some of them are among these unique features: the 90% distribution of income feature, the mandatory listing feature, the mandatory valuation twice a year feature. So there are quite a lot of them that differs us from what is available elsewhere. But I'm sure as a concept, we have a lot of similarities than differences. Thank you.
And Dr. Surya Perumal, one last question, because investors are actually quite concerned about this tax. So, what kind of tax treatments of the real estate investment of an investor is available? What is the tax treatment?
Thank you. So in general, there are multiple taxes applicable relating to real estate investment transactions, starting from it could be stamp duty at the time of transfer, there could be capital gains to the transferor or the sponsor, depending on how the transferor has recognized the property in his financials. If it is an investment property, he has to pay a higher tax than a PPE recognition. Then there could be ongoing value-added tax applications. There could be withholding tax applications. There could be further capital gains at the time of disposal. So taxation could be a nightmare in this entire equation. In Sri Lanka, unit trusts are considered as tax pass-through structures since 2017, meaning in simple terms, the income, the revenue generated by the unit trusts are considered as not income of the trust, but income is holding on behalf of the beneficiary. Therefore, there's no tax applicable. Having said that, the tax administration is with the Inland Revenue, it is not with the SEC. So the final determination is with them. However, the SEC, as we speak, we are making representation to the relevant ministries for the national budget to introduce additional benefits in order to ensure REITs will take off in Sri Lanka. That such benefits could be varying from the stamp duty waiver that was prescribed in the 2016 national budget to capital gains tax waivers to value-added tax exemptions or zero-rated based on value-added. Likewise, so there will be a lot to come in time to come, I would say, but the final authority is the Inland Revenue Tax, not the SEC. However, we join hands with the industry and the stakeholders to request this relief to ensure the REITs as an investment instrument will take off in Sri Lanka. Thank you very much.
Right, Dr. Suryapirim, thank you very much. We really appreciate um, your interesting presentation as well as the insights on the questions. So if we do not receive any more questions through the chat box, I think we can move to the next session. Thank you again, Dr. Surya Perumal. So we often remind that this whole event is supported by many helping hands. One of our academic partner, Kyushu University, Japan, is also one of the key contributors of this successful event. So to acknowledge their support, we have arranged to play an introductory video of the Kyushu University, Japan. So that we can now move to our second discussion. Financial reporting provides a vital set of information about the financial health and activities of the company to its stakeholders. When considering the company assets, biological assets also play a vital role. To explain more about the assessment of fair value of bearer biological assets for financial reporting purpose, focusing on the approach and methods applied in the backdrop of COVID-19 pandemic, I would like to invite the Secretary of RICS Sri Lanka Leadership Forum, Chartered Valuation Surveyor, Mr. D. Pratapa Singha. Mr. Pratapa Singha holds a BSc in Estate Management and Valuation from the University of Sri Jayewardenepura, MBA from UK, Postgraduate Diploma in Economic Development from the University of Colombo, Diploma in Surveying from the University of Reading, United Kingdom. He is also a Fellow of Royal Institution of Chartered Surveyors and a graduate member of Institute of Valuers of Sri Lanka. Not only that, he is an expert from the industry, being a senior chartered valuation surveyor in Sri Lanka, accounting for over 20 years of experience as a professional valuation surveyor. Mr. Pratap Singha, I would like now cordially invite you to make your speech.
Thank you very much, Hasini. I hope you can hear me. You all can hear me. Good afternoon, everyone. Thank you again. First of all, I'm honored to send warmest congratulations on behalf of RICS Sri Lanka Leadership Forum for the ICREMV 2020, which is one of the landmark academic session in the industry of real estate and valuation for Sri Lanka. So, and also I'm honored to share my experience with you all today, and thank you very much for inviting me to do my presentation at this conference. My topic is today, it's the assessment of fair value of bearer biological asset for financial reporting purpose. So I'm going to discuss the approach and method we applied in the backdrop of COVID-19 pandemic. Let me go through the content of course is introduction, client requirement, challenge, and methodology approach. When it comes to introduction, let's just go for the brief introduction. This my property includes 30 states located at different part of the country, which consists tea, rubber, and coconut plantation, and also the tea factories and the hydropower plant as well. This, of course, agricultural property is managed by the regional plantation company in Sri Lanka. So the asset classes comes under bare biological asset, bare land, buildings, plant and machinery, furniture and equipment, motor vehicle, computer, hardware, and software. The main focus here is to according to client requirement to value the bare biological asset. So purpose, of course, as I told you, is the assessment of fair value for financial reporting purpose. So the interest to value is leasehold interest. You all know that the Sri Lanka regional plantation companies is govern the lands owned by the government of Sri Lanka. So it's under lease agreement. So this particular asset, they have unexpired term of lease is 25 years, for which I have to get the value. That is my scope. That comes in my scope. And when it comes to fair value assessment, this is according to the principles set out in the IFRS 13, of course IFRS 13, and also International Valuation Standard 300, valuation of financial reporting purpose. When it's, I'm not going to describe the what is fair value and all that, but we all know as well as fair value is simply the price that would be received to sell an asset or pay to transfer liability in an orderly transaction between market participant at the measurement date. You all have to remember here most important words, the market participant. Valuation of accounting standards applied in assessment of fair value. The different standards applies. First, the RICS valuation standards, global standards, incorporating international valuation standards. Second, Sri Lanka accounting standards. So when it comes to fair value, of course, it comes under IFRS 13. when it comes to Sri Lanka is SLFRS 13. So more on top of that, this assignment comes under the Sri Lankan accounting standard SLFRS 13, LKS 16 and LKS 41. I'm going to explain how this applies. So when it comes to LKS 16, this talks about the property, plant and equipment. Those are the tangible assets that are held for use in the production or supply of goods or services, for rental to others, for administrative purpose. And assets are expected to be used during more than one period. That is what is defined in the LKS 16 as property, plant and equipment. My assets are coming under this category. All the assets what I described before is coming under this definition. So when it comes to bare biological asset, this definition is a bare plant which is a living plant that is used in the production or supply of agricultural produce, and also is expected to bear produce more than one period. Those are the more important keyword here in this assignment to be addressed. So, and it also has a remote likelihood of being sold as agricultural produce expected for individual scrap sale. So my assignment is coming under LK 16 and LK 41, which explain what is biological asset and how the crop plantation coming is valued under this standard. Especially when you go to the LKS 41, is very clearly defined what are the biological assets there, and also the biological assets, agricultural produce and produce that are result of processing after harvest. My particular asset category is coming under biological asset, which is, for example, when it's say tea bushes, that is the bare biological asset. When it's the coconut plantation, rubber plantation, which is come under bare biological asset. According to the pair value of bare biological asset is arrived in line with the accounting standard financial reporting purpose. The pair value is a market-based measurement in perspective of market participant, not an entity-specific measurement for a particular operator. What we have to remember is here the pair value is in the perspective of market participant, which is not an entity specific or a particular purchaser or buyer. So this is an assessment of pair value, and in this assignment, my scope was to value each asset separately as a separate entity. Then let's go to the client requirement. My client was, as I told you, they are the regional plantation company in Sri Lanka, also owned by the UK-based investor. So what they want is to value mainly the bare biological asset for each state separately. And also they want to value the leasehold interest of the asset. That's the legal interest that we have to value. So and we were given the each asset register where different line items of asset given. Accordingly, the bare value asset is the one of the line. So, but I have to value everything in line with the FAR given. So, in this case, the most critical factor is to get the valuation of within 3 months. So that is the critical about the challenge in this assignment. What I found, because there are 30 states, so to be valued. So then I'm going to discuss with you and share my experience how we managed to get this assignment done within the deadline. What are the challenges we face? How we overcome those things? The main challenge was, of course, this assignment came in early March. Once we discussed this assignment, of course, with the client, there's no signs of COVID or anything in Sri Lanka. But all of a sudden it came in, and the second week of the March, all country went on lockdown. but my client insisted that he wants to get the assignment within the given time period, within 3 months. So then we have to discuss and finalize what are the options available to complete the assignment. So there we discuss certain strategies to get the valuation done on time. So therefore, we after the series of discussion, having assessed their information availability and other supporting information with them and with us as well, based on our experience and competency, we decided to go on desktop mode. Desktop mode is the valuation which is carried out on desktop basis, where no physical inspection is carried out to assess. That is a big challenge. Without doing physical inspection to the property, how we can carry out the valuation, maintaining the objectivity and independence in line with the accounting standards. So, of course, desktop valuation during the COVID-19 lockdown period, RICS has recommended under the guideline, RICS guidance on impact of COVID-19 on valuation. The RICS guideline issue that if client wants, that valuer can resource into a desktop basis, provided the both agree to carry out the valuation in desktop mode based on the information available. With that information, with that guidelines and standards available from RICS and also other global valuation institution, we propose our client, okay, we can carry out this valuation on desktop mode. So that is very well accepted and agreed by the client and other audit firms, auditors as well. So then we plan out what is the strategy and the plan of getting information right through across the to avail for us to carry out the valuation. The main challenge is in this case to get the relevant and quality data and information. That's the main challenge. So there we supported, of course, the client that to get the valuation information. There are, of course, the actual information in formal manner. To support for them, we prepare the template, data template, different type of data template we prepare and make them convenient, comfortable to collect data. So based on our template, they collected data and information on behalf of us. So we were able to reach their database to get whatever required data. So we got that. And we, of course, had a series of discussion with their space managers and their head office accountants and other relevant authorities to get information right as required for our purpose. And also the other main challenge was verification and validation of data and information received. So this is the most challenging part in this assignment. So just because you get the data, you cannot just carry out the valuation. You as a valuer, you must make sure that your information input to the valuation is true and correct and is in line with the market participant perspective to meet the definition of fair value. To do that, we had to spend 50% of our time allocated for validation and verification purpose. That we carried out, of course, through data using our own database and database of the company. And also data obtained from small plantation, other similar plantation companies, and also plantation companies and medium and small holders of in the industry. We had to do a lot of research and we had to do lot of market inquiries to get information as required for this item, and using market norms and industry information. So various approaches we adopted, strategies we employed to collect relevant data, and we verified and validated all the information provided in line with the fair value requirement, and then also in meeting the Sri Lankan accounting standards requirement. So this is the with all these, then next challenge goes to how to accommodate this information, validated information and research data and everything into the valuation practice. So this is the most challenging part we have to overcome. So then what we did is, with the discussion of the client and other auditors and other stakeholders in the assignment, we introduced the particular valuation model to arrive at the value of bare biological asset. So we initially, as I told you, we collected data and we accordingly we tabulated every information in line with the requirement of the valuation. Then we prepared the valuation model. In this valuation model, all the asset what we got to value is categorized into two segments. One is cash generating unit, and the second is non-cash generating unit. When it comes to cash generating unit, we have to define what is cash generating unit. That is, of course, is in line with the accounting standards. When it comes to cash generating unit, is defined as it is an entity that generates continuous cash flow over the period days. So then the valuer has to analyze the data and asset and identify what are the cash generating units. For example, tea plantation is a cash generating unit that generates cash flow right throughout the life over the years. And when it comes to tea factory, it's a cash generating unit which generates cash flows over the years to come. And also the hydropower plant. Those are kind of business entities. They are generating cash flows. So those assets and ancillary assets attached to these main assets are categorized within the concept of cash generating unit. So, and which are not any asset which are not fall within the cash generating unit, categorized under non-cash generating unit. So you may see in the model here in the presentation how we have differentiated those different asset categories. With that definition, differentiation, then all cash generating units we value based on the investment method of valuation. Of course, the profit method. We estimated their operational capacity, potential with the information provided and also and validated by us in line with in the perspective of market participant. For example, we were given cost profile, we were given their yield profile, estate profile, land, when it comes to tea factory, their tea productions, their production capacities, all the information we verified and validated with the standard information and norms available in the market industry to meet the requirement of the fair value definition. And also, on top of that, it is done with the expertise and experience of valuers. With that, we analyze the data, we accordingly establish quality data input to this model. So with that all information, we carried out all valuation of cash generating unit by employing investment method of valuation. Once we completed the valuation of all cash generating units separately and with the investment method of valuation, then next challenge goes to apportion this value between the other asset categories. Why we did it? Why we did it is that this value is generated with the help of all the assets given in the stage. You need all the assets here, bare land, buildings, plant and machinery, furniture, fitting, equipment, everything, human resource, everything you need to generate this income. Yeah, but this generated income, this estimated value is the value supported by all the asset categories class given here. So this value has to be apportioned among the different asset categories. So therefore, what we did is, so then here our target is to arrive at the value of the bare biological asset. But what happens is, when it comes to bare biological asset, you cannot find bare biological asset purely sold and brought in the market as an asset itself. There's no bare biological asset in the market for sale. No one there to buy only a bare biological asset in the market. So this is a client requirement. This is an accounting purpose. They want it. They want to value the value of tea plants. They want to get the value of rubber plants. So that's, of course, has to be the derived value. To derive the value of bare biological asset, we had to estimate the value of other supporting asset as well in the first place. Now, in the equation, we value all the cash generating unit with investment method of valuation. That is the total value. With that, we have to deduct the value of other asset to derive at the value of biological asset. To do that, we use mainly market approach and the cost approach. When it comes to market approach, where we use the comparison method of valuation. Using the comparison method of valuation, different asset categories valued, mainly the bare land. Bare land is self-valued. We have been given the extent of land area related to the tea plantation. That bare land component is valued based on the bare market approach, comparison method of valuation. Bare land component is set. And the building, plant and machinery, furniture, fittings, equipment, motor vehicle, and other related assets, we valued those assets employing cost approach, mainly the DRC method. DRC method, you all know that depreciated replacement cost basis. Employing that, each asset class is valued separately. So that's of course a portion that we value those items separately, and we got the bare land value as well. Then all value of all asset classes total and deducted from the value arrived by the investment basis. The balance portion is assigned to the value of bare biological asset. This is very challenging exercise, very much challenging exercise, because the Sri Lankan context, there's no the data available, proper data available, especially with regard to the bare biological asset. This kind of exercises are not mostly used. Most of the clients, they value tea estates, they value tea factories, they value rubber estates, not as components. But to meet the client requirement, you as a valuer must be able to find out the solution. To find out the solution, we came out with a model. This model, of course, That was worked out very well, and this is all about the valuers' experience and competency to find a solution in the given context. This is all done on desktop basis. And when it comes to non-cash generating unit, where the asset includes excess bare land. Excess bare land means land which are not directly relevant to the tea plantation. Okay, maybe forest. They are not directly relevant. Maybe reservation. They are not directly, but it's still the part and parcel of the estate. So we have to value those as well. Based on the market comparables, DRC and comparison methods, we value those excess bare land separately. So these values at the end of the day added into the value of bare lands to get the fair value for total assets. So in this exercise, when it comes to the tea plantation with the tea factory, there are 17 tea factories to be valued. There are 30 state, 17 tea factories, and 4 hydropower plants. So then we value tea factory separate, tea plantation separate, the hydropower plant separate. Most of the hydropower plants were given on leasehold. There are the separate operators to run these hydropower plants. So we have to check their rental agreement, where market rent is estimated pound, and rationalize to standardize the rent for to adopt to the investment method. When it comes to tea factory, the tea factory information was given, but the tea factory is an operational trading entity to be valued with the trading potential. Then valuers start to estimate the potential of trading in the perspective of competent operator. So that is the keyword here. Even the client is also querying on this, because when we are doing the perspective of competent operator in even a tea plantation management, a tea factory operation, or hydropower plant operation, so they are doing on actual with their actual operator. But we have nothing to do with the actual operational data or actual operator. What is the fair value definition? The fair value definition requires is to value the property for market participant in the perspective of competent operator basis. So that is a very critical point here. So we have to very clearly demarcate the performance from competent operator from the actual operator. Then you have to rationalize all the information and input you put into the system with proper justification. That we did. I hope this you may understand what I presented to you. This model. In this model, the assessment and estimation of value with proper justification was, of course, a challenge that we faced with. We, of course, were successful, but the biggest challenge was to convince the client the model and the approach and method we adopted, and the rate, of course. For example, cap rate, their cost of operation, their cost of operation may be 85%, but we adopted 65 to 70%. That we had to justify why we adopted 65, why not 85. So we have to say that is in the perspective of market participant, where market comparables available with other similar states, that they are operating at this rate. Just because you are spending more doesn't mean that the market participant will come and do the same, do the operation at the same rate. Then what will happen to the value of the property? So that is the very important and critical point that valuer must look into. And the outcome of the assignment, if I talk to you, the first main outcome of this assignment is we have to find a solution for client problem to get the delivery of valuation on deadline. That is the main challenge at that time. He wanted us to do the valuation within, for particular reason. Of course, there are international shareholders, they wanted to do that, to meet the certain deadlines. So we had to find a solution where we did. And we had to come out of the solution. We, of course, as professionals, we are the solution providers. We had to do that, rather than giving excuses for various reasons. So that we did. That is the lesson we learned here, that we found a solution for a client problem to get the delivery of valuation or data. And second thing is, we established the valuer's capacity to deliver the valuation in a challenging situation without compromising the objectivity by employing innovative approach and novel technology to meet the client requirement. That is the most important thing. You have to innovate new methods and models, and by using technology or otherwise to meet the client requirements. But there's no way you to compromise your objectivity and professionalism. And you have to maximize the accuracy of valuation, minimize the variance of valuation. That's, of course, the valuer's competence and valuer's experience and capabilities. And the third is, we could establish know-how to innovate a model to derive a value of the bare biological asset in an agricultural property to meet the very purpose of that assignment. So once we discussed in the first place, the client was nowhere. He wanted to get this done. We had a lot of discussion, and especially the UK shareholder, they had a discussion with us, and they wanted to find out the way how to find a solution for this. So we established, that we are capable of doing it. We established how to innovate the model. So we introduced the model, we discussed with them, they accepted, even notices accepted, and we go ahead. We went ahead. And we were successful at the end of the day. That is the end of the assignment. I hope you may have a lot of Q&As. Those are welcome very, very much. Thank you.
Yes, Mr. Pratap Singh, we actually have one question from the audience. It is about any unique challenges and issues. I think you already have discussed it, but if you want to give a quick answer for that, are there any unique challenges or issues in valuing biological assets in Sri Lanka?
Yeah, Hasini, as I told you before, the main challenge is in Sri Lankan context, lack of proper data available in Sri Lanka. That's the main challenge. Of course, we have no proper established data, even within valuers, I hope, in the academic era or what the practice. So the data, proper database, established database, we don't have. So that's the main challenge. Even we got data, we don't have quality data inputs in Sri Lanka available, particularly the valuation for bare biological assets. Okay, that is the main challenge. And second thing is that the volume of similar assignment, very few in Sri Lanka, very few. So when there's a little volume, and to get experience of doing this kind of assignment is a challenge. But we as valuers, we are, of course, I know all valuers must be capable. They are, of course, capable to find out a solution, the problem raised by the client. So that we have no way to giving excuses to find out the way out is our, the mandatory requirement. That is the main thing, that lack of data and the lack of quality data and lack of volume of assignment, similar assignment in the country. These are the main challenge. And on top of that, the enough competency and experience in doing so may be the another challenge. But I know the valuers can manage this kind of situation. So that's the main challenge I found in this assignment.
Again, you asked that how should valuers approach such challenging situations?
Yeah. Yeah, no. We of course, valuers must be able to manage this. It's of course a challenge. Every assignment is a challenge at a certain point. Okay, when it comes to bare biological asset, it's of course a challenge, but we must be able to find a solution. We can. yes, valuer that we have been trained for. But the lack of data and lack of quality data and the lack of volume is an issue. That's what about is established.
I also have another question. Before that, I would like to remind you all that you can ask any questions through the chat box. Don't be hesitate to do that. So when I was looking or listening to your speech, I noticed that this was done through a desktop valuation. Am I right?
Yeah, this is the stock valuation,
So I was
yes.
wondering what is the margin of error, or I would say the deviation when it is compared to physical valuations.
Yes, Hasini, that's a very good question. Of course, that I was trying to establish the same fact right throughout. It's of course a challenge. You know, we generally carry out valuation with physical inspection. That's the mandatory. We always do that. But in this particular case, we have to meet the client requirement. Of course, we initially planned to do physical inspection, but due to the COVID-19 situation, we couldn't go out. No physical mobility is allowed, was allowed. So that we had to resort into the desktop mode. So that's a challenging situation. So we manage it. So what the of course I admit that there should be a margin of error in between the desktop mode valuation and also valuation with physical inspection. But our challenge is to mitigate the difference, minimize the difference, minimize the difference. To do that, that's why I told you that's where the valuers, that is where the valuers expertise comes in. Okay, then valuer must be able to find out the tools to minimize the variance. In our case, my experience, if I share with you that the data validation and verification is the most challenging part. There, we have to spend a lot of time. Why we spend a lot of time? To get the data within the parameters of normal standards valuation practice, as much as for nearing to the valuation with physical inspection. That's involved a lot of analysis, a lot of hard work to verify data, to validate data. So with a lot of backing of the market comparables and other research, our own data analysis and all, that we try to minimize as much as possible, but still there must be a difference in between. That has to be. So, and also the, of course, in this case, we did not carry out, but it could have been done through a sensitivity analysis. Sensitivity analysis where you can see the plus minus variance to the certain percentage and analyze the valuation, to carry out the different valuation in between to see the variance of that. So that has to be, if they of course wanted that, we could have done it. We did not do that in this case. That's the matter.
And we have received another comment and question also stating that RICS instructed desktop valuation or draft to first report of an assignment, and we should provide a second assignment for the same with a reasonable period. So the audience, the participant asked what are the difference or margin of error of both.
Yeah, margin of error in general valuation, that's what, you know, in generally, even with the physical valuation, margin error generally is considered in between 10% to 15%. In the very uncertain situation, it could be even go beyond 20. So that valuers must be able to limit the margin of error within the accepted norms, 10 to 15. But of course, when it's come to the desktop mode, that margin of error may be in between 15 to 20. That's all about how valuer manage evaluation, what the quality of inputs available, what the method applied and approach applied into evaluation. So that's all about the how to mitigate, minimize the margin of error.
So I think your all questions are answered. If there is no any questions from the audience, I think we can again move to our next item. Before that, I would like to thank Mr. D. Pratap Singh for joining with us today and sharing knowledge and experience on this very important assignment on assessing the fair value of biological assets. Thank you again, Mr. Pratap Singh.
Thank you very much, Haswini. Okay, thank you. Bye bye.
As I told you that we have been received a great support from various parties. So we must have to remind our academic partner, University Sains Malaysia, who is also a key contributor to the success of this event. So let's now move to a small video of University Sains Malaysia. That is the video of our academic partner, University Sains, Malaysia. Now it's time to move to our third speech. Accurate and updated information that can be easily accessed is quite important and essential for rational decision making. On the other hand, lack of sufficient information may lead to inefficient decision making process. Similar to any other industry, real estate industry, which is now transforming slowly into smart real estate, is also requires sufficient, accurate, up-to-date, and easily accessible information. Thus, it requires further attention. So, to talk about information for smart real estate, I would like to invite our third resource person, Professor Mrs. KGPK Veerakorn, Professor in Real Estate Management and Valuation, Department of Estate Management and Valuation, University of Sri Jayewardenepura, Sri Lanka. Professor Veerakorn holds a BSc Special Degree in Estate Management and Valuation from the University of Sri Jayewardenepura, postgraduate diploma in urban development from University of Moratuwa, MSc in Human Settlement Planning, a PhD from University Sains, Malaysia. And also, Professor Veerakorn is a corporate member of the Institute of Town Planners Sri Lanka and a member of GIS Sri Lanka. The key research interests of Professor Veerakorn are geographical information systems, urban and regional planning, and urban environmental studies. We are eager to listen to your speech, so now I would like to hand over the session to Professor Mrs. K.G. P.K. Veerakorn. Over to you.
Thank you, Ashini. Now, ICREMV is a landmark event in the real estate industry in Sri Lanka, and this is the fourth conference. Then I congratulate to 2020 conference committee to conduct this event in first time in a virtual platform. This is our first-hand experience in virtual platform. However, they did it in a successful manner. Also, I thank ICREMV 2020 committee to given me opportunity to share my thoughts and experience with you. Presently, we are in the information era, and information plays a major role in the function of economy. In past pandemic period, we realized value of information platform. Therefore, today my presentation focused on information for smart real estate. Then the outline, I would like to discuss small things about what is smart real estate. What is real estate? Real estate is an umbrella, and real estate data, information and knowledge, and information for real estate, one by one in this outline. Then, first, I would like to start in an easy point. What is real estate? I'm sure all of you have heard and all of you know about what is real estate. What is real estate actually? Real estate is a property, land, building, air rights, and underground rights below the land. There are different kinds of real estate like residential, commercial, industrial, agricultural, and others also, etc. Then all real estate stand on the land, and the many natural and man-made elements are connected with real estate. Therefore, we cannot consider real estate as a separate part. It is the part of the land. Then, now this is the building. Real estate is mainly connected with buildings. and buildings are connected with main different elements. It then in this example, in these buildings connected with property companies, addresses, contact, I consider in the real estate perspective, in an area, a region, and building name, building ID, sales address, developers, etc. So many items connected with this building. And apart from that, it also connected with physical, social, and economic contents related, economic related information regarding to the building. Then this it is the one point. The other point is real estate is an umbrella. Why I say that? Real estate is connected with multidisciplinary networks, and therefore real estate can be considered as a big umbrella. Many disciplines stand under this umbrella as pillars to strengthen real estate. Those are real estate management, property valuation, real estate marketing and finance, construction, property law, planning, urban planning, etc. On the other hand, all the above disciplines are root of the stem of real estate. Therefore, to achieve smart real estate, we need more information related to those pillars. Now, this is the example. Now you consider, sorry, about real estate data. When making decisions in real estate, we need information about specifically related disciplines in a particular related real estate. We develop real estate information based on real estate data. Therefore, we need to know what is data and information. Now, normally, data consists of raw facts and it acts as an individual unit like raw material, which does not carry out any specific meaning. We could also say that data refers to raw input that, when processed or arranged, makes meaningful output. When data is processed, interpreted, organized, structured, or presented so as to make them meaningful or useful, they are called information. Therefore, information is a processed, organized set of data presented in a given context and is useful to humans. Sometimes information is a group of data that collectively carry in logical meaning. Now, in according to this slide, real estate data connected in different aspects. Now, property related data, land related data, land market related data, land rights related data, planning regulations related data, infrastructure related data, construction industry related data, etc. Now, as an example, in property related data, in property have a nature, ownership, ID, floor area, like that. In land related data, land has an extent, shape, deed, land value, etc. Then land market. Then land market have land prices, the availability of other properties, like that. In the land regulation, we want to know street line, building line. Those are all those are data regarding to the land regulation. Infrastructure, availability of basic infrastructure land, then construction, design material, technology. All these information are connected to data is always connected. The real estate data always connected with some property or any particular land. Then, what is the role of data? Data regarding a particular property, it say where the location of property is. In the there's a location, then we can ask where is the location. It is a one data. Then land, related to the land, how much of extent. Then regulation related to what is street line, building line, that like that. Using data, all of us can get raw facts like this. We have lot of data regarding properties, but we don't have more information regarding properties like real estate finance trend, land value variations, land value trend, new factors affected to land value, like that. Then those are the information regarding to these basic raw data. Then I think most of 80% of our audience consists of valuers. So I would like to take an example from valuation profession. I think all of you must have enormous collection of this raw data. Data is useful, but when we convert this data to meaningful information, it is more useful. Why? Data is always connected with time. All of we know data is connected with time. Therefore, every year data is outdated. And we protect this outdated data as information because we can get an idea about our land market pattern or land value pattern in previous years or previous decades. As professionals, do we have an idea about land value trends in Colombo connected with specific roads or land value variations in specific areas? While all of you have data in hand, we never attempt to convert this data into meaningful information in all ways. Therefore, conversion of this data into meaningful information can be used in decision making, and it is important in smart real estate. Collection of data is not enough to maintain smart real estate. We need to convert this data into meaningful, smart information. Now, data needs to convert into information, then knowledge for decision making process, it can be used. Then how do we convert data to information? Now you have data, but based on this data, you can summarize data. You can averaging the data. Okay. Also, you can selecting part of the data. Then you can draw graphs based on the data, adding some images and locations of data, adding some values to data. Then we can convert our data into information. Now, as an example, please consider the land value of the specific lane connected some specific area. I think you think some local authority area. Then we can summarize. We have a land value connection in year by year. Then we can get idea. When summarizing the data, we can get idea land value variations in year by year. Then we can average the data. Then we can average land values based on some GN divisions and other identified area. Then we can select in some part of the area and we can analyze data of that specific area. But if you think it is the highest land value area, then we can analyze those specific area. Now, those data you can convert into information. You can give an information based on that data one by one. Then after that, we can convert information can be used to decision making process through knowledge. Now we try to identify how we convert this information to knowledge. Then when we converting information to knowledge, we have some questions. How is the information tied to outcomes? Are there any patterns in the information? What information is relevant to the problem? How does this information affect the system? What is the best way to use the information? How can we add more value to the information? Now, those information we can automatically convert to the knowledge. Now, why this information uses in real estate? Now, using this information, we use that information to risk mitigation in the real estate. Simple evaluations, we can do some simple evaluations. Then realtors understand customers' needs better using this information. Then improvement is in marketing strategy. We can use this information for improve marketing strategy. We can use this big data with social media. Then some insurance, then real estate can be get some idea about which type of insurance suitable for this real estate data. Then second one, next one is the information is benefit in real estate. How it benefit in real estate? Information is benefit to risk reduction, improved customers engagement, accurate apps, enable decision making process, marketing strategies, then data driven insurance. These are the information benefit in real estate. Then now all of you know information get more beneficial to real estate. In this case, we need to develop smart information network that suits to our country, the related to real estate data. In this case, what is smart information? I would like to share my idea about smart information, but it is not contradict with our concept smart real estate, but this is for data. I identified it differently related information network. Now, smart means related to the information network. S means specific. We need specific systematic model should be suited to our country, not not like other countries. Our country is very specific because we have so many data barriers. Therefore, we want to identify our barriers and limitations, and we want to prepare a suited model for our country. Then M is manageable. The information network should be manageable to us because we don't have high technology. Then we cannot maintain high databases in the entire country. Therefore, our information network should be manageable for us. The third one, accessible. Information network should be accessible to all relevant decision makers to fulfill their requirement. Then reliable. Information network developed to dependency of quality services that will lead to economic development of the country. Also in last one, T, transformable. System has the ability to transform the sort of dynamic situation. Then the next one is the information network. We have to consider the proximity measures. If we are developing smart information network, then the proximity measures can be related. Then first one is the organizational proximity. Then promote common understanding and minimize their tensions. Then institutional proximity, coordination and fruitful interaction we want to develop. Then cognitive proximity, evaluate the content, help to mutually understand and exchange valuable resources. Then geographical proximity, collaborate as spatial relationship facilitates the formation and the determination of the bonds. Now, information for smart real estate. Then how we, now you have idea about, we convert data into information. But if we have a big data, large amount of data, we cannot easily convert it to information. At that time, we have to develop smart information platform. Then smart information system. We have to use smart information system for smart information platform. Then we can achieve smart real estate. Therefore, when we want to consider smart information platform, how to develop smart information platform for achieve smart real estate using information system. Information system is very useful for converting large data to information. Then this is the example of another country. Now they have some data model. They prepared data model based on properties, real property types, apartment fields. There are so many data included their model. But sometimes we cannot prepare model like this. That's why I say that our information system should be specific, not for other countries. Now this is we cannot develop this type of information model, but we can do something. Then next slide I would explain. Now we can develop this type of basic information platform. Then we can do property features and property attributes. Property attributes we can combine in geo information through Google Maps, and we can mapping regional profile, we can mapping transport profile, we can mapping facility profile. In those information, we can connect it with basic profile of property attributes. That type of information network we can easily develop, because you have data, we have data, all we have data, but there is no data platform. There is no, therefore, we don't have information. That's the main thing. Therefore, if we want to develop some kind of smart real estate platform, we have to develop smart data platform. Then I think in this initial level, we can do this type of information system. Now, this smart information network, that the next problem is how we develop this smart information network. Then we can develop smart information network in small to large level. It means community to national level. First, we want to consider community, local, regional, national, like that. Now we can say it should be a bottom to top approach. Start from community and gradually connect to local, regional, and national level. Our existing administration structure can be used to define national, regional, local, and community level. We have to connect this local level with community level through GN divisions, and GN can be considered as small community level in spatial entity. As such, our information network coordination platform should be started at community level. If we are think to prepare database, we always think in massive level. But no, don't like that. We can start our information network in the community level. If we start to develop databases at community level, automatically databases would be developed at local, regional, and national levels. Then in this case, when we develop a smart information network, we have to face some problems. First, we want to clarify those problems. Then first one, what is the scale of the area we need to collect and organize data? What type of data we need to collect and how to coordinate with others? How do we develop simple database at local level and integrate them with comprehensive databases at national level? Then how do we gather data into digital platform and how do we retrieve the data for decision making? Then last one, how do we collect data and coordinate data collection at local, regional, and national level? Then this is my idea, but I don't know it is suitable for you, but this is the best idea to develop smart information network for us. Finally, I conclude all things. Then, especially in our real estate industry, major lacking part is property information because of lacking property database. If we have good property database in the entire country, obtaining property information is easy. But today we waste so much time to collect property data. Our country has data barriers and limitations to access of data. Therefore, I propose simple, easy process to use in our country to develop smart information network connected to the pillars of real estate umbrella. If we coordinate all data in a different discipline into one platform, it will automatically generate property details and it will help to develop smart property information network. Finally, this integrated information network among disciplines will in turn benefit decision making in real estate industry. The last but not least important point is sustainability of this process. In this case, we need to discuss it in multidisciplinary approach with decision makers. We have to get decision makers help to develop this type of data information system. Okay, thank you very much.
Right. Thank you, Madam. We have received one question from the audience. I would again remind you to please raise your questions through the chat box. If we go to the question we received from the audience, it asks, Internet of Things devices have become an essential component in designing smart cities. Internet of these devices rapidly collect data and information in various dimensions, leads to an abundance of rich data and information. So, how can we manage such abundant data? What are the risks associated?
Yes, Hashini, your problem is good, but thing is, in our country is very poor country compared with the data. Then most Southeast Asian countries has rich databases, but we don't have rich databases. Then, in my view, all data directly connected with time, and immediately it was outdated. Therefore, in the smart concept, we cannot think about the smart concept. It is a very vast concept. Therefore, we need collection of this rich data. Then when we collect rich data, we can convert immediately. We can convert it within 1 year or 2 years. Immediately, we can convert to meaningful information is very essential. Then ethically, we can give proper. When we use that type of information, ethically we can give proper references to them. If we preserve more valuable data as a property, we have to put barriers to protect that information. In my view, data should immediately convert to meaningful information for use. The decision making process is very important in like our country, in like our field.
Right, Professor. Thank you very much. That question was actually raised by a participant from the audience. And if I raise another question, we know that there are actually, I just received, I think, another question. Which kind of contribution is expected from real estate professionals?
Yes,
My
actually,
question was also related to that as well. What is the contribution that is expected from real estate professionals and other parties to implement these smart real estate applications in Sri Lanka?
yes, actually, I think if you can manage small database, there are so many open source softwares are there. If you can manage in your data in the information system like QGIS is a very good platform. It also connected with Street Map. Then it is very easy to manage. If you can manage, then after that we can develop some data forum. Then we can collect all data. I think first we can start those data interaction in the basic information. First, we can collect basic information, property values like that. Then we can develop some basic information platform. First, you can develop your own data. Then we can amalgamate those platform to the one entire small local community platform. Then after that we can combine that community platform to local level and regional, district and national level. I think it is the best way. I think your best thing is you try to manage your data in the within the information system, or you can connect your data collect in such a way. And then after that 1 year, if you think you collect data in within 1 year, then you try to give some analyze those data and give some information about that. That is the important thing. As a real estate professional, you have to do that thing.
Right. So it's clear that it has to start from the big grassroots level. That means the through individual levels. We all have to.
Yes, yes.
Have to yes. Okay. Thank you, Professor. With that, I really would like to thank you, the Professor, Mrs. KGPK Virakon, for joining with us today and sharing your knowledge and experience on this timely, important topic.
Thank you, Hashimi.
Next, I would like to remind the great support received by our collaborative partners from the beginning of the first conference, with whom we have a strong connection from for a long time now, and we have been receiving great support from them to be organizing the ICREMV 2020. So let me quickly remind our valued collaborative partners: Government Valuation Department, Sri Lanka; Urban Development Authority, Sri Lanka; Colombo Municipal Council, Sri Lanka; Institute of Valuers of Sri Lanka; RICS Sri Lanka Leadership Forum, EMV RCD Club, and EMV Crew. The support received by all the heads of those institutions is very much appreciated and anticipated for our future event as well. So with that, we have reached to our final but a very important speech or presentation on a timely topic. Let's go to that. The COVID-19 pandemic has already made a huge impact on almost all the industries. The consequences of this is not still clear for the economies of countries in general, and especially for the real estate markets. And everybody is concerned about the direct as well as indirect effect of COVID-19, because it is really is a key topic concerned by many parties, including investors. Identifying this need, we invited another industry expert to talk about dealing with uncertainty from COVID-19 pandemic in assessing market value of office building complex. The final presentation on this topic will be done by Chartered Valuation Surveyor, Valuation Manager at Valuestrat Qatar, Valuestrat Dubai, United Arab Emirates, Mr. Anthony Fernando. Mr. Fernando holds his BSc Honours degree in Real Estate from the University of Greenwich, London, UK, and he is also a member of the Royal Institution of Chartered Valuation Surveyors. He has experience in the real estate industry, working predominantly in the field of property valuation as well as real estate advisory, feasibility studies, highest and best use analysis, development appraisal, and real estate market research. Once again, I cordially invite Mr. Anthony Fernando to proceed with the speech. Over to you.
Thanks for that introduction, Hashni. I hope you can see my screen properly. I'm sharing it with you now.
Yes, Mr. Fernando. Yes.
Okay, great. First of all, I'd like to thank the organizers and the committee of this event for giving me this opportunity to talk about basically what I want to do here, to share my opinion of how we do valuations over here in Qatar, and maybe hopefully how valuers in Sri Lanka can adopt something from what we do here and make a collaboration of those ideas and try to do valuations as correctly as possible. And at the same time, we are currently dealing with the COVID-19 pandemic and how we can address the issues of uncertainty and do valuations in a way mitigating risk as much as we can. Before I start my presentation, I also want to give a quick introduction about my company, that is Valuestrat. We are one of the leading real estate consultancy companies in the Middle East, mainly in Dubai and Qatar. We also have offices in Saudi Arabia and the United Kingdom. All our offices generally provide 4 service lines, which is real estate valuations, market research studies, plant and machinery valuations, and advisory and business valuations. Of course, we are an RICS regulated firm, and there's over 40 years of experience in the Middle East region. And it has been 6 years since we have established our branch here in Qatar, with among all our branches, there's more than 100 employees. Moving on to what I want to discuss today. The main objectives of the discussion is doing a valuation or assessing the market value of an office building or a complex, if you will, using the income approach. Now, as an income generating property, an office building is most appropriately valued using the income approach. And of this, if we are talking about an office building that is in multiple occupation, where you have existing leases and existing tenants, it is most appropriate to use the discounted cash flow, which is a technique under the income approach or investment method, if you will. Overall, we will talk about an overview of the DCF, more like a hands-on demo of how you would approach doing a valuation of an office building in multiple occupation. We will talk about the users and the benefits of the DCF, why it is important to use a DCF and what benefits we get from it. We'll also be going over the components and, like I said, the overview of a sample case study. And towards the end of the presentation, we'll be talking about how to assess the uncertainty arising from the recent pandemic and what measures we can take to mitigate the risk as much as possible, and also how we can address the uncertainty within valuations and our report. I'll be using a lot of advice and evidence and guidance from the RICS and IBSC. So I hope we can take these guidelines and also use in the valuations in Sri Lanka. And right at the end, we'll also be talking about comparing valuation approaches and some of the concerns that we should give regard to when doing a DCF valuation. So moving on, what are the uses of the discounted cash flow? Why give so much importance to it? Now, it's not to say that other valuation approaches may be wrong, but I would consider that, in my opinion, doing a valuation of an income generating property, especially if it is in multiple occupation, a discounted cash flow is more appropriate. So because you can show a clear narrative of how the future cash flows are moving within this investment. It's important to a potential investor who wants to, say, purchase such a property for his investment purposes. He would want to see how his incomes are generated over the years. And this information is also useful to lenders. For example, if we're doing a valuation for secure lending purposes, lenders would want to see how income is generated in these properties and how they can appropriate their loan policies and installments based on this investment. Secondly, transparency of inputs and ability to make interim allowances. This is one thing that is probably lacking in other methods under the investment method or income approach. In a DCF, you can project a 10 or 15 years cash flow, and you can make interim inputs and allowances, like if you're expecting predicted incomes. For example, here in Qatar, we are expecting the FIFA 2022 World Cup. So when we do a DCF, we can project higher occupancies, maybe additional growth in rents, closer towards this event and maybe slightly after. Obviously, this would be based on historical events after talking to experts. And even when it comes to costs, if you are expecting certain costs to be made in a building, you can address these in a periodical way rather than at the beginning of cash flow or right at the end. Thirdly, incomes such as rent can be projected in a DCF, but you can also use this for profits. For example, if you're doing a valuation of a hospitality project or a hotel apartments, resorts, for etc. The information that we get from third parties or even our clients can be used, obviously with an objective view of how these would actually work within current market terms, and they can be appropriately placed within a discounted cash flow to show the flow of income and the flow of your expenses. You also have the ability in a DCF to make real-time cash flows for predicted incomes and costs, which is pretty much what we just covered. And you can make sensitivity analysis and make account for sensitivity within a discounted cash flow, because these are not just straight inputs that you're using in any model. You're projecting cash flows over a period of time. So you can use sensitivity of the inputs that you're using and make variable changes to see how the outcome might change depending on how you change your inputs. And the DCF becomes extremely useful when doing such a study. And also finally, it becomes an easy reference looking from a retrospective view. For example, if you did a valuation of an office building today, if you were to do the same valuation a year or 2 years down the line from now, you can look at the previous inputs and assumptions that you used in that valuation. And not only that, if you were looking at a DCF done by a different valuer, you can also analyze the inputs that they have used and what assumptions regarding growth and occupancy they have considered in theirs, and compare it with current market conditions to see were those assumptions correct or were those expectations realistic, and make a future analysis how you can go forward from where you are. So these are the main uses of a DCF, where it becomes useful when comparing the times of now and how you can analyze the future incomes and expenses and so on. So next, I would like to take a brief overview of what are the components of a discounted cash flow. Just to keep it simple, first of all, we'll be looking at revenues and incomes, how they are generated. So first you'll be looking at your passing rents. Then you would passing rents if you have existing tenants. The demo and the presentation I'm making is specifically existing tenants and lease agreements with agreed upon rents. So you'll be looking at passing rent and upon reversion, once a lease agreement has expired, what kind of market rent can you revert to from that point on? Keep an eye on inflation and predicted rental growth. Now, predicted rental growth becomes a challenging unless you're actually living in an advanced country where you have historic information based on events. If you have predicted cash flow, both trajectories from historical figures, it's easy to predict rental growth than inflation. Otherwise, ideal cash flow, if you haven't got enough data to support rental growth, you would stick to inflation. Secondly, you would look at your operational expenses and running costs. These are typically the vacancy, your OPEX, which is your operational expenses, and your CAPEX, which is capital expenditure. Again, capital expenditure would typically have to come from information directly provided by a client. Obviously, you can predict these looking at the building from your inspection. You can make certain assessments of how much of CAPEX that you might have to spend. You can compare these with previous valuations and data collected from previous buildings or assignments. If you don't have enough evidence to support how much of capital expenditure to use as, let's say, a principal, you can include these in maintenance and operating costs, for example, in OPEX. Thirdly, once you have your revenues and expenses, you would look at your discount rate. I will go in more detail about how we can assess the discount rate, the capitalization rate, and finally, how we would arrive at the market value. So to go over a simple example of what a DCF looks like, we set up our parameters. Then you have your tenants. I've named them as A, B, C, D, E. And also you would have to make allowances for maybe you have in your office building owner-occupied areas or vacant areas. So you would also have to make allowances for those areas within your DCF. And then you would consider your lease expiries, the dates. You would project your passing rents based on actual lease agreements provided by the owner or representative of this building or the complex. You would account for your market rents, and then here you might see that I only have 6 years projected in the DCF, but ideally just imagine this in the sense of you have years 1 to 5 and then 6, 7, 8, all the way up to 10. It's just for demonstration purposes, I've limited it to 6 years. I'll also quickly turn over to the Excel of the same example that I've done. You would account for your inflation. Over here in Qatar, inflation is generally at 2.5% over a historic 10-year average. So that is what we use in our valuations, as you can see here. And when we are using the discounted cash flow to predict your future incomes, for example, tenant A, his lease agreement expires in year 1. So that is clear for the next 12 months. We're assuming that end of year 1 is 12 months from the valuation date. So for 12 months, we're using his passing rent. And in year 2, we revert to market rents and predicting the same for the remaining years of your DCF, but also accounting for the inflation of that particular year. So all passing rents are usually static. These are fixed rents, or maybe you have rent reversions. Based on that, you would apply the DCF accordingly, but typically passing rents are applied without inflation, and market rents would be inclusive of predicted inflation for that year. To give you another example, here you have tenant D, who has a 4-year remaining lease agreement. So for the first 4 years, you're typically using passing rents, and starting year 5, you revert back to market rents and so on. And ideally for vacant areas, or let's say owner occupied areas, we consider passing rents because we cannot ignore these areas that are existing within the building. I'll move back to my presentation. So here you can see, based on these principles, we can analyze what our future incomes are going to be starting from year 1 to year 10. The next slide, we are starting to apply expenses and running costs to our DCF. We would typically start with occupancy. You can apply vacancy as a cost in your DCF, or you can reflect it as per gross income after occupancy. So here, accordingly, in my DCF, I've considered occupancy at 60% as per real time, what we see in the current building, and accounting for some occupation of the vacant areas in year 1. And you have to make an analysis of how occupancy is going to work in a building, starting from what is the stable occupancy of an office building based on the location and stability of the market and so on. And you have to analyze how quickly vacancies can be filled in an office building based on current demand and supply and so on. And once we apply occupancy, we calculate our gross incomes, and then we can start to apply running costs to our DCF. Now, typically running costs, as valuers, we have our databases of what are typical costs in office buildings, but it is also advisable to consider actual costs from this particular building that you're valuing. Accountants usually keep data of how building expenses, or if you speak to facilities managers of these buildings, they should maintain records of actual expenses. And you would break down accordingly and show those expenses in your discounted cash flow. And we also have to additionally account for letting fees, because you do have vacant areas, and filling those vacancies would, depending on how the market works, you would have to pay agents or realtors a certain fee for filling those expenses, and you would also account for that in your DCF. After deducting your expenses from your gross income, you would arrive at your net operating income and record it, as you can see here. Now, we come to a more sensitive component of the discounted cash flow, and the main component, I would say, is the discount rate. If I could draw your attention to RICS and IVS, According to IVS 105, Valuation Approach and Methods, paragraph 50.31, it says here that, excuse me, valuers may use any reasonable method for developing an appropriate discount rate. While there are many methods of developing a discount rate or determining the reasonableness of a discount rate, a non-exhaustive list of common methods includes a capital asset pricing model, or a CAPM, a weighted average cost of capital, a WACC or a WACC, observed or inferred rates of yield, and a built-up methods. Now, I wouldn't say that Qatar is a transparent market by any means. So we do have our own challenges of making assumptions or making predicted analysis of discount rates and capitalization rates. The ideal situation would be for us to use something like option C here, which is observed or inferred rates of yield. You would look at rates of return from similar buildings in the subject area or in the market, but you should also have historic evidence of this data so you can build a model where you can predict what your discount rates are going to be. Unfortunately, due to a lack of transparency, what we like to do here is use a built-up model. Now, in this built-up model, if I, again, if I would refer your attention to the Red Book, we find this paragraph under business valuations and business interests, para 7.15. If I could read it out to you, it says present value techniques measure the value of an asset by the present value of its future economic cash flow, which is cash that is generated over a period of time by an asset, group of assets, or business enterprise. Now, this refers to typically valuation of a business, but we can use this principle to determine the discount rate of an office building in this case. It says here also that the rate of return incorporates the risk-free rate for the use of funds, the expected rate of inflation, the risks associated with the particular investment, and the market. Now, these are the components that we use when we do a built-up method to determine what the discount rate should be. And we have pretty much an sort of like a definition or an understanding of the discount rate. The discount rate selected is generally based on rates of return available from alternative investments of similar types and quality at the valuation date. So this is an example of something that you can develop or something that you can approach to do in determining a discount rate. This is something that we use here, not among all valuers as general. This is something that we use in our company. Like I said, when it comes to valuations, there's no one-size-fits-all answer to determining risk or uncertainty in valuations. So the best thing that we can do is take the guidance and regulations provided by the IBSC, the RICS, or the Institute of Valuers in Sri Lanka, for example. We can use these guidelines and do the best that we can to approach a situation rationally and try to mitigate risk as much as possible. So what we have done here, for example, is create a sort of a matrix where we create parameters for a minimum base yield starting from the discount rate. This is the method of actually the built-up method that we were discussing earlier to determine the discount rate. So you would start with the risk-free rate that is from government bonds. And on top of that, you would add property risk of individual attributes of this particular property. And on top of that, you would add market risk. So when you're creating your parameters based on your experience in the market but actual data that's collected as well, you have to determine, okay, we know that government bond rates are at a certain rate. It's at 2.5%. And on top of that, you can add the risk premium for the subject property based on age, technical conditions, and so on. It should be at 3%, and risk premium for commercial real estate sector in the market at 2%. And what we can do is build a scoring system. Let's say you have 5 categories starting from very good to poor, you give it a score, and do a weighted analysis of individual attributes of these main 3 components, which is your property risk, your market risk, and government bonds. Government bonds are typical. You would start from there. And looking at the property risk, you can give attributes such as location, technical conditions, accessibility, visibility, and access to amenities. You can adjust these according to the market in Sri Lanka, for example, and give each attribute a certain weight starting from 25, 20, and 15%. And based on this matrix that you have built, as you change these figures here, I'll also show you this in the Excel. You have the same example here. You can change these attributes as you will and as appropriate to the subject property. And it will change the rate that you should use, or the risk will change depending on, for example, here the technical conditions of the building and the market risk based on competition, demand, and region popularity. I would say this is, I won't say this is the most appropriate way, but this is something that we can develop to try to understand how we can come up with a way to determine discount rates in a market that's where you have less transparency. And it's also a way that is easier to explain to your client depending on his use, and also make a rational judgment for yourself as a valuer. And obviously, once you decide upon your discount rate, you will use the present value formula in your DCF to determine the present value of future incomes. And that's exactly what you have, what you can see here. You take your net operating incomes, you apply your discount rate. You might notice here that I've applied 7.5% for the first 3 years, then upon reversion, it's 8%. This is mainly because I've given a bit of a benefit for this building, because you do have existing leases, and that mitigates the level of risk in the property where you have fixed rents. And these rents are close to rack rents, I would say. So I've given a bit of a benefit to this building, saying the first 3 years in average have better security than when it would revert to market. So when it reverts to market, we have slightly increased the risk to reflect accordingly. And then you get your present value of cash flows. I realize I'm running a bit short on time, but I'm going to go quickly because the remaining parts are typical. You can decide the exit value based on the cap rate that you're using. And you would also have to revert this to present value of your exit value at the year 10 or 15 as appropriately, depending on what kind of DCF you're using. And if you sum all of this up, the present value of your cash flows, including the present value of your exit value, this would typically give you your market value of this office building. And this is the general approach that you would use in a discounted cash flow to determine the market value of an office building in multiple occupation. Now, moving on to assessing uncertainty. Some of the things that we can do is, we did already talk about the built-up method to determine the discount rate of an office building. So giving regard to the current COVID-19 crisis, and depending on how the market is responding to this, you can add additional market risk in the model here. Under market risk here, we have considered 3% as typical market risk premium for your property. Depending on how the market works and how the property works, you can add additional risk to your premium, so your discount rates will be adjusted accordingly. Another thing that you can do is you can use multiple valuation approaches and make reasonable rationale to reconcile the differences in values between different valuation approaches. Referring back to IVS, in our valuation reports, we are not required to report more than one valuation method, but at least from an internal perspective, for our own rationale and judgment, we should try to use several valuation approaches to try and make sense and reconcile the differing values. And it is also appropriate. We have come across situations here in Qatar where we are doing valuation of a commercial property, and the income approach did not reflect the appropriate market value for various reasons, and we elected to go with a different approach. In these situations, we actually show both approaches in our report and make a rational conclusion as to why we have gone with a particular approach and disregarding the other one. But sometimes it does become important for the sake of our clients, depending on the use of users of the report and depending on the purpose of the report. It does become important to show why we have selected one approach over the other and what's the rationale behind it. Thirdly, especially in crisis times like this, I know it's difficult sometimes because we valuers, we always have issues with deadlines. We have to stick to certain deadlines and make sure that reports go out in a timely manner. But due diligence and extra observation becomes very important during times like this. When it comes to comparable research, we have to do primary if secondary is not, I would say, fruitful enough. It becomes clear sometimes when you actually physically go into neighboring buildings and try to understand the occupancies and the rents and so on. And when you compare these with listed properties, for example, in websites or newspaper listings, you might find there's a big difference between askings and actual leases. So depending on what you find, you have to make reasonable adjustments to reflect the gaps between listed rents and actual rents. This could also be applied to market approach in any other valuation approach as well. Also, you have to make allowances for unobservable inputs in valuation methodology. You can do this through yields. For example, if you're using inputs and assumptions in your valuation like a DCF, and the inputs that you're using, such as rents, occupancy, things like that, if these are unobservable inputs, referring back to the hierarchy of comparables, then you have to make allowances for this, and you can do this through yields. But again, we have to be reasonable with how we make these adjustments. Something also what we can do is stress testing of variables. We can use, like we discussed earlier, a sensitivity analysis to show how differing variables can have differing outcomes in your valuations. And this can be reflected in a way that you can show your clients that, okay, if these inputs or these adjustments were to be changed, this would typically be your outcome. You can use it for yourself as well to make rational judgments about how a sensitivity analysis and how your inputs can make changes to your valuation. And then finally, do not confuse risk with uncertainty. We have to make objective views regarding the significance of uncertainty within a valuation report and the parties that may rely on such evaluation. We do various things, as we discussed so far, to try and mitigate risk as much as possible. But there is also a factor of uncertainty which we have to address in our valuations. And how we do this is through making clear rationales, clear assumptions and special assumptions if need be in our reports. And we have to be objective when making certain assumptions or making certain judgments in our valuation. Especially if you're using unobservable inputs, we have to be transparent with our client within our valuation report that we have made a rational and objective judgment on these inputs. And we have to, according to the guidance from IBSC and RICS, we have to make clear rationales in our report and explain these to our clients accordingly. What are the uncertainties? What are the inputs that we have considered? And how we have objectified them and verified them in A, B, C, D, and so on. And finally, the last part of this presentation is you might find certain issues when you're doing several valuation approaches to justify, let's say, your DCF. For example, if you did a valuation of an office building, you did an income approach using a DCF, and then you might do a cost approach using market approach to ascertain the market value of the land. And on top, you'd add the depreciated replacement cost of the building. And you might find that there's a difference between the two. Let's say a 5–10% difference is usually reconcilable, but anything bigger than that could be an issue. And how would you assess these situations is that you would go back to, let's say, the point number one here is plot regulation and highest and best use. Has the subject building been constructed to its highest and best use based on plot regulation. Is the GFA, or the gross floor area, is it up to standards? Is it according to the plot regulation? Your FAR, again, directly relates to GFA. GFA and FAR is typically the level of the built-up area that is above ground level, obviously making allowances for your balconies and your technical floors, etc. Sometimes you might find that the building is not built to code. That is why your leasable areas have become less than what they typically should be. Hence, it's affecting your income approach when comparing with a cost approach. You must also look at existing covenants and the tenant mix. Maybe you might find that in your list of existing tenants, some are paying below market rents, and some have allowances and things like that, which doesn't reflect the full potential of the income generation in a building, which may ultimately affect your market value generated from a DCF. So you might have to look at this carefully to see how it works. And also finally, you can compare your GFA to leasable area ratio. Ideally, according to my experience here in Qatar, the leasable area of a building should be at least 70 to 75% of the GFA. I've come across situations where it's less than 50%. And in these situations, I had to present the facts that it's not been built to the highest and best use. Therefore, we have to use a different approach to determine the market value of a particular building. And I think with that, we've come to the end of the presentation. And I hope this was useful for all of you in Sri Lanka when doing valuations. And you can adopt something from this, at least to show how this, you can use these methods and ideas that I've discussed to ascertain market values or assess market values or any other value of properties when doing valuations. And back to you, Hashni, if you have any questions from the audience.
Right. Thank you very much, Mr. Anthony Fernando. Looks like we have received 2 questions on your presentation. One, actually, I think you all can see. The other one is received as a private message. Anyway, let's move to the one that you can see. Tools like NPV, PV, and FV became unpredictable after pandemic situation. The interest rates and discount rates changed drastically. The inflation also changed or forced to change. How do you determine the use of NPV and FV after pandemic situation?
Okay, so clearly this is the biggest challenge when assessing the market value of any property today. The pandemic is a very recent issue, and we have not spent enough time within this challenging period to understand how these effects might affect our PVs, our rates, and inflation going forward from here. It is unpredictable, but what we can do is to be as rational as possible as valuers. And also, I have to say that if we are using certain inputs and assumptions and making predicted outcomes for the next 10 years based on findings of this small period of time within which we have spent with the pandemic, it would also not be fair to your building, because we still don't know that the pandemic, how long it's going to last and what the lasting effects are going to be. The best thing we can do is we can look at what were the historic figures. And so far, based on what we have seen in the market changes, how have certain inputs been affected by the pandemic in the recent months? And we can make certain allowances within the inputs that we're using, such as discount rates. You can use rolling discount rates to address the pandemic, let's say in the coming year or two, and revert back to normalcy afterwards. Because we have to try and reflect, there's no, from the beginning, like I said, there's no one-size-fits-all answer to this current situation. So the best thing that we can do is try to approach each individual input in a rational way. We have to make our own judgments based on observations, based on historic data. and try to be as fair as possible when we use these assumptions in our valuations. I hope that answers the question.
I guess so, yes. And the second question I received through a private message. It is about AMV. Do you use automated valuation modeling in Qatar or any part of Middle East for office real estate valuation? Any thoughts on AVMs?
Sorry, Hashini, you were breaking up there. Could you repeat the question, please?
Yeah, sure. The question is related to the AVM, automated valuation modeling.
Okay.
Uh, do you use automated valuation modeling in Qatar or any part of Middle East for office real estate valuation? Any thoughts on AVM?
Okay, yeah, that's a good question. Personally, within ValueStrat, we don't use AVM. We try to use manual models that we built based on the databases that we have and information that we have taken from trusted sources. So we do our own models, but there are many companies that use AVM. And I would like to expand a lot more on AVM, but I wouldn't want to, mislead anyone because it's not within my expertise to use AVM. But it is a common thing in Middle East. I've also worked in Dubai. I've also seen companies using AVM there. And it is, you could say, a common tool to use in valuations. But in my opinion, as a valuer, it's better. Okay, I'm not saying it's better, but it's more useful to do your own methods and models because you can justify them easily rather than using a model to generate inputs for you. But yes, to answer the question, it is a common method. The question of reliability, I would say, depends on the opinion of each individual valuer.
Yes, the uniqueness of properties, I think, is a big barrier for AVM.
100%.
And
Yeah.
also, since you are you have preference for office and commercial real estate office market, I would like to ask you a simple question about flexible workspaces. What are your thoughts on flexible working spaces? Is that a passing fad, or can it actually make an impact on the office market? And are
Yes.
there any flexible workspaces available in Qatar?
Yes, that's true. It has become an increasingly famous phenomenon ever since the pandemic, because here in Qatar, especially, I can't refer to other Middle Eastern markets, but here in Qatar, since the pandemic and even before, the office market was facing some difficulties because there was so much supply in the market, the demand could just not reach that level. So it would be wrong of me to say that the office market has been challenged since the COVID, but the challenge for the office market started even before, and we saw a slow increase of flexible office spaces. More and more companies, there are companies like Regis, for example, in Qatar. They offer these flexible workspaces, and more recently, towards the pandemic, let's say starting from February, March, April, we saw a change in companies changing their addresses and changing their options for physical office spaces to more remote areas. So by doing this, the pandemic was an eye-opening situation for most companies, even like ourselves, that the work that we do can be carried out remotely. We don't need to have physical office spaces. And a lot of companies actually started realizing this and started opting for flexible office spaces and also finding alternative ways to have their employees employed in remote areas rather than in a physical office space. But unfortunately, we do find that flexible office spaces the rents for these are quite high in comparison over here. So for example, you'll be renting a smaller area at very high rents per square meter. And this has become a deterrent for most users, I would say. But it is an existing phenomenon.
Right. With that, I think we can conclude the final presentation. Thank you very much, Mr. Anthony Fernando,
Thank you for the opportunity.
For your very informative presentation. Thank you everyone for raising questions and also participating in this session actively. I'm sure, as I mentioned earlier, we gained a lot to take back today from these wonderful presentations. So a special thank goes to our respected dignitaries of the industry dialogue session. Let me remind our resource persons again. Dr. Harshana Surya Perumal, Director, Corporate Affairs, Securities and Exchange Commission of Sri Lanka. Mr. G. Pratapasinghe, Chartered Valuation Surveyor, Secretary of the RICS Sri Lanka Leadership Forum. Professor Mrs. KGPK Veerkon, Department of Estate Management and Valuation, University of Sri Jayewardenepura, Sri Lanka. Mr. Anthony Fernando, Chartered Valuation Surveyor, Valuation Manager at Valuestrat Qatar, Valuestrat Dubai, United Arab Emirates. Once again, thank you very much for our key resource persons for joining with us today. Lastly, before concluding today's events, I would like to remind you all the final event or the day of ICREMV 2020 that we are planned to start at 1 o'clock in the afternoon tomorrow. It is a real estate talk that would be conducted on the topic role of real estate market, stepping towards developing to develop. 7 key individuals from the industry as well as from the academia will be joined with this event. This is an integral part of the conference aiming at sharing knowledge and building relationship between academia and the industry practitioners. We invite all of you to join and update your knowledge on these key trending areas by joining this event. So with that, I leave you. Thank you very much again, all of you, for joining us today, and I hope to see you all tomorrow. Have a good evening and stay safe.